Hello and welcome to Buffett's Books. This is Preston Pish, and I'm going to be helping you work through a stock split whenever you're trying to determine the intrinsic value of a company. A member of the Buffett's Books forum, Steve C. is what he goes by, posted a great question on our forum and where he asked about stock splits. And he says, last night I was calculating CVS's value when I noticed something. He says, I noticed that CVS did a 2-for-1 stock split, I believe in 2007. How would this affect our intrinsic value calculation? And then he lists what he determined the intrinsic value to be, which he thought was $133. So what we're going to do is we're going to help out Steve here and try to discuss stock splits and how we might interpret the information found on the income statement, balance sheet, and cash flow statement. So before I begin, let me talk to you about what a stock split is, just in case you don't know. A company has two different ways to conduct a stock split. They can do a simple, 2-for-1 stock split, a 3-for-1 stock split, or they can also do it through issuing it through a dividend. So what we're going to be talking about here is just a simple stock split. We're not going to be talking about a company issuing shares through a dividend, which kind of goes through definitely a different way of accounting. And that's something that you can research if you're interested in. But a simple stock split, let's say that you own 100 shares of a company X, okay? And let's just say that the book value for company X is $10, the earnings per share is $1, and the market price for company X is currently trading at $20 a share. So if this company would do a 2-for-1 stock split, what that means is that they're going to issue an additional share for every share that you would have. So in the scenario that I just described, if you had 100 shares of company X, after this 2-for-1 stock split, you would now possess 200 shares of this company. You didn't have to buy those additional 100 shares. They're just given to you by the company. Okay? And what happens whenever you have an additional 100 shares, and since this happens for everybody and not just you, what you'll see is that book value will go from $10 down to $5. Your earnings per share, instead of it being $1, is now 50 cents. And the market price most likely will follow from $20 down to $10. So all the company is doing is they're basically lowering that market price. So let's say that the company has a target that they like to keep their stock price around $50. So if the company has been continuing to grow, and let's say that the market price is at $100, they might do a 2-for-1 stock split in order to bring that market price down into the $50 range. Okay, so that's why a company would do it. So now that we understand that, let's go ahead and answer Steve's question here by pulling up CVS Pharmacy and see when their stock split occurred and how we might interpret that information. Okay, so here I am at MSN Money, and I'm going to go ahead and pull up the ticker for CVS Pharmacy, which is just CVS, and I hit enter. Okay, and you can see it brings us to our top level page for CVS Caremark. So the easiest way to kind of determine where a stock split might occur is to go to this 10-year summary, okay, right here, and we'll go ahead and click on 10-year summary. And what we're going to be looking at is the number of shares outstanding, okay, which is right here in this column. So you can see that highlighted in yellow. And as we look at the number of shares outstanding for CVS, you can see we'll start at the bottom in 2002, and you can see that there was 786 million shares outstanding on CVS. And as we keep going higher, you can see that the company was slowly issuing more shares, okay, which would dilute the value of yours. If you owned one share, that would dilute the value as they're issuing more. But then, as you can see in 2007, you see that the shares jumped from 825 million clear up to 1.44 billion. So this is a good indicator that this is where the stock split occurred. And although it's not a 2-for-1, like I'm sure the company issued, what you probably saw was the company actually bought back some of the shares, or there was something kind of unique going on with the accounting. But that's where the stock split occurred, because you can see a major jump in the numbers there. So if you owned one share in 2006, whenever you go into 2007, you're now going to own 2 shares because of the stock split. So did your share become more valuable or anything like that? Not really, because it's just all proportional. Since you owned one before and all the shares doubled, now you basically own the same stake of equity in the business. So then as we look at from 2007 to 2011, you can see that the shares slowly decreased. They went from 1.44 billion down to 1.3 billion and at the end of 2011. And that's a good thing for you as a shareholder because that means that the company's decreasing the number of shares that are outstanding, so your shares slowly become a little bit more valuable based off of that. So the way that I would go about trying to calculate the value of this business is because you're going to have an issue if you use the intrinsic value calculator and you just go from 2002 clear up to the end of 2011 because there was a change in the number of shares. One share back in 2002 isn't the same value as one share in the end of 2011 because the stock split and there's double the shares. So the way I would do it is I would simply just go from the numbers in 2000, the end of 2002 up to the end of 2006, okay, and I would figure out how much the equity had grown between that period. Then I would go to 2007 and do the same thing from 2007 to the end of 2011 and see how much that equity grew during that period. And then I would just average the two together, and that's what I would use for my estimated book value growth. Now, something that I want to add for CVS is this is kind of a unique situation because CVS had preferred shares for a lot of the time during this 10-year period. So if you really wanted to do this calculation accurately, you'd have to go back and you'd have to subtract out the preferred shares from that equity in order to get a good estimate of what the actual book value for the common shares are. Now, I talk about this later in Course 2, Unit 4, I believe it's Lesson 3. You can go into that lesson and you can learn how to basically subtract out the preferred shares out of the overall equity of the business so you know what the common shares are actually worth. So if you want to do this really accurately, you'd have to go back and do that. But for this real quick example, we're just going to assume that there were no preferred shares during this entire duration, and we're just going to go ahead and estimate how much the equity has grown. Okay, so in order to do that, let's go ahead and pull up our intrinsic value calculator on Buffett's books, and then I'm going to go ahead and walk you through the process here. So here's we're at the top level page for Buffett's books, and let's go ahead and pull up the intrinsic value calculator. So you'll just come up here and hover over calculators, and then you'll go to intrinsic value calculator and select that. Okay, and you can see that here's our calculator down at the bottom. We'll just push this off to the side. Okay, so when we want to see how much the book value has grown, we have to go to key ratios on the CVS page here. Okay. And then we'll select 10-year summary. Now this is a different 10-year summary than the 10-year summary that we clicked on earlier. You're going to see different numbers here. Okay. Now when you come down and you look at the book value per share, which we're interested in, you can see that in the end of 2002 it was 6.61, and then up to the end of 2006 it was 12.01. Then you see this tremendous leap in book value up to $21. This is always a really good sign that something funny has happened, and you're going to probably have to go back and look at the 10K in order to see what actually happened here. Okay, and what happened was a couple different things. You have the stock split occur where you have double the number of shares. And it's also whenever CVS took on their second part of their name there with Caremark, that's where they conducted that acquisition. So the book value jumped tremendously, not only because of the increase in the share price, but if you go back and look at the balance sheet, you're going to see an enormous amount of goodwill added to the balance sheet because of the premium that they paid in order to acquire Caremark. So that's something that you can either discount down if you don't believe that the goodwill was actually pertinent, the amount that they put on the balance sheet. But that's something for you to determine. For this basic scenario, we're just going to assume that everything that they have listed for goodwill, we're going to count as actual value to the business. Something else that I'd like to highlight is that whenever you're talking about book value, I've always just kind of taught you that you go into the equity and you divide out the number of shares to get the book value. But if you're actually calculating according to accounting terms, the book value of a business, you have to subtract out, once you get that equity number, you have to subtract out any intangibles and then divide by the number of shares. So if you're going by the exact accounting term for book value, that's how you're going to do it. But once again, we're just going to kind of use this as a basic scenario and just kind of use the numbers that we're given here. But if this was a company that I was seriously interested in investing in, I'd probably go back and do all this hard math in order to make sure that it's all the numbers check out and the returns that I'm going to be expecting is what I'm actually going to be getting. Okay, so let's go ahead and do this for the numbers that we're provided here with the book value. So the current book, what we're going to do is we're going to do this twice, okay? The first one we're going to do is the current book. We're going to assume that we're just going from the end of 2002 up to the end of 2006. Okay, so the current book we're going to use is 1201. Okay, because this is where it ended. We're going to assume that this is time now. Okay, where the 1201 is at. Okay, then our old book value we're going to use the 661. Okay, now the time frame that this occurred was 1 year, 2 year, 3 years, 4 years. Okay. The easiest way to do it is just count how many numbers there are, how many figures you have over here, and then subtract 1, and that's how many number of years you're going to have in here, because you're accounting for the difference between those years, and that's why you have 1 less. So when we calculate that, we get a 16.1% average growth for the book value on CVS during that time frame. Okay, that's fairly substantial. That's a lot. Okay, so they were growing a lot during that period. Now let's do it from 2007 up to 2011. Okay, so we're going to go ahead and put new numbers in here. Okay, we're just going to go ahead and delete those out. So the current book value, we're going to go ahead and list at $29.32. Okay, so $29.32. And then the old book value, we're going to use the 2007 number because that's where we left off. The last one we put in was 2006. So for 2007, we're going to say it's 21.8. 21.8. Okay, then the number of years between there, if we're starting at 21.8, it's 1 year, 2 year, 3 years, 4 years. Okay, so we're putting 4 in there, and then we're going to hit calculate. And you can see that the book value growth from 2007 on was significantly lower at 7.69% annually. Okay. So now what we're going to do is we're just going to average those two numbers together. Okay, so let me pull up Excel here, and we'll just do the simple math problem. We're going to hit the equal sign. Okay, and the equal sign, we're just going to go ahead and sum 16.1 plus 7.69. Okay, and then we're going to divide that by 2 in order to get the average. Okay. And our average came out to be we'll just say 11.9%. Okay, that's how much the book value has grown over that 10-year period. Okay, on average. Now, whether you think that that's a more aggressive number or not, that's for you to determine. That's where a lot of the art of asset valuation comes in, and whether you're taking a conservative approach or you're taking a more aggressive approach, that's something that you're going to have to determine. For me, over the last 4 to 5 years, the company's book value has only grown at about 7.7%. So for me, I might not use this 11.9. I might actually use the 7.7 because recently the book value hasn't been growing as much. Now, if you want to take the more aggressive approach, you could use that number, or you could even use the number from 10 years ago. That's up to you. So that number that we just determined is going to go down in here into the average percent change in the book value. So I'm just going to put, I'm going to put 8% in there. Okay. Now we determined the average was 11.9, but I'm going to take a conservative approach, and I'm going to say that it's going to probably be similar to what we've seen over the last 4 years. So let me just put the exact number in here. I'll put in 7.69. Okay. That way you understand why I'm using that specific number. Okay, so the cash that can be taken out of the business. This is the dividend that we expect to receive. Okay, so let's go ahead and pull up the top level page here for CVS so we can see what the dividend is that they're paying. And they're paying a 65-cent dividend right now. Now, that dividend might be higher in the future. You might want to put something in there. You might want to look at the average dividend payments over the last 10 years and look how they've grown and estimate what the average would be for the next 10 years, because that's what that number represents. But for me, I always put in the current dividend because I'm going to assume that it's not going to increase over the next 10 years because that's a conservative estimate. Okay. And the nice thing is I do that for every company that I relatively compare. So it's not like I'm giving CVS the benefit of the doubt and another company a different estimate. I always just use the current dividend in order to estimate those returns. Most likely it'll be higher. Okay, so my estimate of this company's value is probably going to be a little bit lower than what it actually is. Okay, but the key is that I do the same technique for each company, and that's what you need to make sure you adopt. Okay, so the current book value of the company. In order to calculate the current book, you can either go to the balance sheet and just take the equity and divide it by the number of shares, or you can come in here and just kind of use their quick estimate, which is under financial highlights, and you can see it's $29.50. Okay, so I'm going to put $29.50 in there. Now realize that $29.50 has a lot of goodwill on the balance sheet. Let me show that to you real fast. So we go to the balance sheet. Okay, and we're on the interim balance sheet. And you come in here and you look at the goodwill. You can see there's a ton of goodwill and intangibles on this balance sheet. Okay, it comes out to be about $35 billion, $36 billion. Okay, and when you look down here at the equity, it's almost matching the amount of equity in the business. So for me, that's a lot of intangibles for a company. I would probably kind of steer away from that. If you wanted to take a lot of that out of that equity right there, you could drastically decrease this book value right here because of so many intangibles on their balance sheet. So this is another reason that right off the bat, I already know I'd probably be staying away from this company just because they don't have any assets behind the way that they're making their money. Tangible assets, I should say. Okay, so right off the bat, we're going to go ahead and compare this company to a 10-year federal note. Okay, so whenever we do that, the 10-year federal note's around 1.5%. So we're going to estimate these cash flows for the next 10 years, and the current 10-year federal note's 1.5%. Now, this is what I really want you to take away from this. We're using 1.5% only because we know that that's a zero risk investment. Okay, so whenever I hit calculate on here, it's going to give me the intrinsic value. And that's basically going to be the value that this company is worth if you wanted to get a 1.5% return on your money. Okay, if you would buy it at that price. So let's go ahead and hit calculate. Okay, so it comes out to be $59.31. Okay. So if I could buy, my estimate based off of those numbers is that if I could buy CVS, okay, right now it's trading for $44.75. But if I could buy it for $59.31, I would get a 1.5% return on my money. Okay, so that's the zero risk investment. That's when you're comparing it to a zero risk investment. Okay. We know that the value it's not trading for $59.31. It's trading for $44.75. Okay. So what we have to do is we have to adjust this rate right here to see what kind of return we would get based off of the current price. Okay. So let's go ahead and plug in 4.5% and see what we come up with. Okay. So that came down to $44.99. Okay. Well, we're right on it right there. Okay, that's close enough for me to say that we're relatively at the same estimate. Okay, so right now, based off of all those numbers, okay, we're basically saying that if we could buy this company right now at the current market price of about $44, almost $45, that we could expect a 4.5% return on this company. That's how much we think it would make over the next 10 years. Okay, so the way you got to look at this is it's always relative. Okay, the reason I plugged the 1.5 in first is because that showed me what the comparison would be to a zero risk investment. Well, CVS obviously has a lot of risk because it's an equity and it's a business that may or may not meet those cash flows that we just estimated. Okay, so the question you have to ask yourself is, if we can get a 1.5% return with zero risk, and we can get a 4.5% return with some risk, especially considering how much intangibles are on their balance sheet, is that worth it to you? Okay, and that's only a question that you can answer. For me, for this type of return, this isn't a really strong return. I'm not real happy with the balance sheet because they have a ton of goodwill and they have a lot of intangibles on there, which is stuff that I can't get back if this company would fail. Something else that we got to look at real fast before we finally declare that this is what we think the value of the company is. Let's go in here and look at the future earnings of the company. Okay. So first we have to understand what the current EPS is on the company, and we scroll down here and we'll look, and the earnings for the company is $2.65 a share. Okay. So that's what they're making right now. Let's go ahead and look at the future earnings in order to see if that's going to be consistent and all those cash flows that we just estimated will actually come to fruition. So we got to click on earnings, and you look in here and you can see that the earnings forecast for 2012 is $3.29, and for 2013 it goes clear up to $3.70. So that's all good. That's excellent. Okay, so that's a good indicator that all these estimates, that the book value is going to continue to grow at about that percent, and that they're going to continue to be able to pay that 65-cent dividend. All of that is accurate. This is a conservative estimate. Okay, and my conservative estimate tells me that at the current market price, I think I'll make about a 4.5% return on this company, which is kind of low when you relatively compare it to other picks that are out there right now. So this is something that I would probably not purchase, especially with the balance sheet looking the way that it is. So that's the analysis that I go through with this company. If the return would come out to be like 10% or higher for this company right now where the market's at, I would then go back, and then that's whenever I would start trying to pull out all the preferred stock to make sure that the book value that I'm coming up with is accurate for the common shares. That's when I'd really start doing a lot more digging. But there's no need to really dig that deep when you're just trying to get a real rough estimate of what the company's worth. And that's what I just walked you through. So hopefully that helps you out, Steve, dealing with stock splits. That's a real quick way of going through and estimating what a company might be worth who's experienced something like that over the last 10 years. So if you have any more questions, or anyone else out there has questions of things that you're coming across while you're trying to assess the value of these businesses, make sure you log on to the forum and post a question like Steve, and I'll be sure to try to get in there and help you out. Thanks for watching.